All right. Good morning, everybody. We got FOMC minutes today. We also have Jackson Hole still on Friday. Um, Japan meeting on the 23rd. Powell and Jackson Hole on the 23rd. Seen a little bit of the carry trade in the negative yesterday. It was like 2.5% around midday. VIX expiration today. Yeah, I love that. Turn that off. Looking at things that were in the squeeze list, there was a number of Bitcoin names that were in there. Not that we want to run after those, just seeing where the flows are at. It's going to be late on this news today too, so it messes up the afternoon 0-day plays. Bond auction today, the 20-year, and then tomorrow we're going to get the 30-year. It's kind of a big deal. And then next week, Monday and Tuesday, is very likely to see a market on pause while we wait for NVIDIA. We say that, but depending on how it goes in Jackson Hole, we might not see a pause for NVIDIA's earnings like we did on their last earnings. Last time they reported it was on a Wednesday, and on Monday and Tuesday, the market was in the tightest range that we've seen in a while. There's been some talk about a revision in the employment numbers, Philly Fed numbers. So I want to continue to keep our eye on any of that data that comes through. Still waiting on Spot Gamma to come out with their AM founders note. One of the things we picked up from the PM edition founders note was that we got a new call strike, 5750 for the call wall, but they said that was more of technical level than anything else, and that they still liked 5600 as a pin candidate and a call wall. So something to keep in mind too. We have a 100 point 21-day average daily range. So from the Globex open at 6 o'clock last night, it's 50 points higher, 50 points lower. And within that red boundary is the 100-point daily range. If we get aggressive to one side, we'll move 100 points up or 100 points down. That'd be the yellow lines, the average daily range. Right now, we're just doing nothing, holding the line since yesterday. And that's what we were expecting to do all week. Monday was a little bit of a surprise getting that expansion that we did. But this is the base case argument as we're waiting on data. So Could we get out of this range? Yes. If there's some shock to the system, say the numbers don't match what people are expecting, if there's something in the FOMC minutes that moves market mood, that can bring us out of this box. Otherwise, we're waiting on Jackson Hole. I mean, the auctions could go wrong too. That we could have some really bad auctions at 1 o'clock today that send us out of the box. Otherwise, we're really just expecting to peak outside the box one direction or another and then come back in again. No matter which side we take, it'll give us a double bottom or it'll give us a double top. Remember, double bottoms and double tops are traps. That's what they're supposed to do, right? So if we go back to the top, it's a bull trap. If we go back to the bottom, it's a bear trap. But it's only a trap if we actually convince traders to get in there. So we want to see price come up and break through that high and get above it. Liquidity resides on the other side of the pivot. Or we want to see price come down and test that low and get through that low because liquidity resides on the other side of the pivot. The spot gamma index is at 1.8, so it is in the positive. This implies that breakouts won't stick, that if we do get a breakout, we'll come back in again. And we're still in a high volatility environment. The daily expected move is less than 50, and the daily one standard deviation is just above 50, while the 21-day average daily range is 100% greater than that. If you know anything about standard deviations, you could say right now that we're running on an average of a 2 standard deviation, which is in the 95th percentile. I know it's way too early for that nerd talk, but it's a lot. We got a pretty narrow channel this morning. It's not as narrow as it could be. It can be so narrow that you don't see any cloud at all or any yellow lines. You could just see a purple line there. That's how narrow it could be. So it's not as narrow as that. It is greater than the previous day's channel, and it's completely outside of the previous day's channel, which is a little bullish. Price is back above it, but we opened underneath it, and we've been crisscrossing back and forth through it. When we're above it and we come down into it, it'll act a bit like support. If we're completely underneath it and we run up into it, it'll act a bit like resistance. But when we open at that level and we're just crisscrossing back and forth through it, at this point, their price will have no respect for it. It won't act as a support or resistance. And it's very much like a magnet at this point. We're just holding this level. So we won't see it as any target, magnet, support, resistance. It's worthless on a day like this. It gives us no context, no insight. Our distance from the weekly pivot was set Monday, really, and we haven't done much with it since then. And this is nothing compared to the 5.5% and 6% distance that we were seeing in the last 2 weeks. So if you look at Monday and think that we were overbought in the near term, not even close. Looking at the weekly volume, there's really nothing out here until we get up into 5,700, which is a round number anyways, 5692 cog line. It's the last high on this run up where we started to get that topping pattern and we rolled over back in mid-July. There's a lot of volume at that top. Call it buyer's remorse or unfinished business or any other way you want to frame it. That's where the greatest amount of trading took place. There is an expectation that should we get there, we'll find it very difficult to get through there, at least on the first try. but that's a long ways off anyways. It doesn't seem like very far. We're at, 56.28. We're talking about 56.98. So what, 70 points? It's not much. We can move 70 points, no problem. But it's not the number. It's just finishing that final lap, right? Making that last little bit of distance. And from a pure price perspective, we stalled out for the first time on this run up. And I think a lot of people are beginning to look for that pullback that we've been all on the hunt for. There's still a lot of work to be done if we're looking for very clean, specific signals. Markets move in a clean fashion, and same thing on the other side. What does that start to show there? It's an inverse head and shoulders at the top of a range on a daily. Now, head and shoulders and inverse head and shoulders, they can be continuation patterns, not just reversal patterns. It's not as common and it's hard to follow through with them, but they can be continuation patterns. So an inverse head and shoulders can actually be bearish. It's one of the reasons that if you find an inverse head and shoulders at the top of a zone, one, you shouldn't immediately think that it's a long trade continuation, that it might actually just be a bearish pattern. Either way, if this is setting up as an inverse head and shoulders, we would look for the right shoulder, and that should be a pullback that stops above the left shoulder, right? The way head and shoulders generally show up. When you get the right shoulder and you start getting the pullback on the left, you get the left shoulder first, you start to get the right shoulder. It doesn't normally come below that level. It can, but we would want to see it stay above that level. That would be a good head and shoulders or a good inverse head and shoulders. It is worth noting that the head and shoulders pattern is the butt of all jokes when it comes to trades, right? Because if that's the only thing you have for the trade, then it's probably not going to work. You want a lot of other reasons besides, oh, it's a head and shoulders, because they fail a lot, especially on the bigger time frames. On the intradays, it's not so bad. You see a lot more follow through and really clear profit. But on weeklies and dailies, I mean, a weekly head and shoulders can last months, right? It's worthless. It's just not useful. We do have the 10 and 21 trying to cross back through the 50. Prices above the 10 and the 20. 10's crossing through the 20. All of that is really bullish signals. But we had, an exaggerated fall and then an exaggerated rip back in the other direction, cutting through all of these moving averages and just tangling them together that makes it trash. So from where we're at, up above it or below it, whether they're sloped and whether they are fanned out, moving averages can give us insight from that, but we don't want to look at them as any form of support or resistance or, any kind of language like that. Volume's a little lighter today than it was yesterday. We're sitting at 41, and yesterday we were at 48. It's the overnight volume. We're in a really low volume environment, and I get it. A lot of new traders don't grasp this logic, but low volume can make big moves, right? Because it doesn't take a firm with any real size to make the market move. If they start trading and taking liquidity, they'll move the market. We've got a lot of forced buying going on, and it's being done in low market volume conditions. So that's one of the reasons we're getting big exaggerated moves. $10-day, 30-minute volume profile. I think it's a lot more likely that 56.28 is going to be the new point of control, unless we drop back down into 75 and build it out, and or we drop down into 54.75 and build that one out. But we would have to come down into those levels and give it enough volume to beat our current levels of volume, this 56.25 area. That doesn't bode well for us on the idea that very likely by Friday, we're going to have the point of control over our head, and it's going to act as a significant resistance to the market going forward. If by Friday we're higher than the high that we set yesterday, then sure, it'll act as a support and we'll be able to lean against it and continue an upside run. But who knows where we're going to be by Friday? What's much more likely, or what's much more certain, is that's going to be the point of control. At this point, the only thing that would not make this the point of control is if we sell off and then catch support at 55.65 area and or drop down into 54.50 area, right? See these two zones. So we would have to sell off and then hang out there. That'd be the only thing that would make either one of those even a running chance of becoming the point of control. We don't have a VPOC from yesterday to carry forward. Talked about yesterday how a really tight range is when a market builds up energy. Well, it's not giving us a direction. It's not giving us, a signal for higher or lower. It's just telling us that we're building up a lot of energy. That continues to be true even now. But at what point is the battery charged and you're full of juice and ready to go, and we're still not going anywhere? So we're on hurry up and wait mode. On the one hand, it sucks sitting around waiting to finally come out of all of this and make a move. But on the other side of that, it is nice having a very clear range. We'll just start with the current range, this Globex range. Get out of this to make a move to the edges. Higher or lower, it doesn't matter. Now, I like to trade long off of the lows, so I'd rather try to go long around that 56.20, 56.18 and be in it so that when it does break through that high, I'm already there and we run it up into like 56.40. If we're going to go short, I'd rather go short around that 56.32 cog line and already be in it when it breaks through that low for the downside target. Now, obviously, we got to those levels in the middle of the night. We weren't there to trade it. So now we're looking at being in it, trying to trade it as a breakout. But that's the small range. We still have to get to the edge and then play the other range. And again, I'd rather go long off the lows and short off the highs rather than trying to short the lows or buy the highs, especially when we're waiting on data and we're expecting a market to go sideways. Holding the range is the base case argument, and we're expected to break the previous low and expand a little bit to trap those bears, or break the previous high and expand a little bit and trap those bulls. So just because we break out on one side or the other does not mean continuation and trade in that direction. We have to get through the buy zone on the bottom, or we have to get through the sell zone on the top. I like to use the 111 It's not the only thing out there that you could use, but it's certainly the one that I like to use. So this is the buy zone, and it's at the round number between 5607 and 5603. And that's the sell zone. $56.44 to $56.48, give or take, right? We would have to get on the other side of that. And of course, 56.50 is just on the other side. So then we'd have to get through that. And on the downside, if we did get through the bottom, the round number is there, 5,600. So even if we get through the buy zone, we still have to get through 5,600. Then we could see some move to the downside. So as you can imagine, this range is going to be very strong and difficult to get through. So I was looking at Jackson Hole over the last few days. And if we go back all the way to 2020, here was Jackson Hole. We finished the month, got into September, and then everything started to get really negative. We went sideways. So it's not an immediate sell-off from that Jackson Hole, but in the very next week, it was all we had, right? So the end of August, we started to sell off into September. Notice that week for the Jackson Hole, it was bullish the whole week. We just kept running and running. We talk about waiting for Jackson Hole, waiting for data. We're on wait. Well, in 2020, we just kept on running. So then we had 2021. Big pop on Monday, just like we had this week. Sideways Tuesday, Wednesday, and Thursday. And then on Friday, we had an engulfing bar that covered all of Thursday from the top and the bottom. But that was pretty much it. We stalled out the next week and we started selling off after that into September. Starting to get a little bit of a theme there, right? 2022. Monday, big down day all the way to the edge of the weekly expected move. Tuesday and Wednesday sideways, just trying to hold the line. Reasonably decent move on Thursday to get us back towards last Friday's close. And then Jackson Hole and a big move to the downside that kicked off the September selling, and down we went, right? And then 2023. Decent move on Monday. Tuesday, sideways and worthless. Wednesday, really big move on Wednesday. Took us all the way outside of the weekly expected move. Thursday brought us all the way back in again. Friday, we were sideways on that Jackson Hole day. Really didn't get much of anything. The next week, strong boost and a rally, but then we got into September and the selling began. So sure, we're bullish. We're getting some good flows. We are just right around the corner from a sell-off into September. And these wait on Jackson Hole events the last 4 years has shown we don't really get a whole lot of waiting. It helps to turn on things like FOMC. I don't have the minutes marked, the week that we get the minutes. I just have FOMC itself. They're not usually close together with Jackson Hole, but the minutes are. So maybe that would be worth marking out, seeing how those line up a little bit better. (1.72% above the 10-day moving average means that we're still farther away from the moving average on a daily time frame than we would want to be. The sweet spot is around 1.5. So the fact that we're above it kind of implies that we're still a little bit ahead of our skis and we need to hold the line a little bit and give that 10 time to catch up with us. This is called a correction, right? When a market moves fast and then it needs to correct itself. Two ways a market can correct through time, meaning we just sit there and let the market heal, or we correct through price, in which case we would pull back towards the mean. Well, we're really not falling, so we would call this a correction in time, but we need another day at least to get back inside the box. We're 2.43% above the 10-week. Not quite at that 2.5%, but we are getting closer to the sweet spot. This is where we would want to be. We're about as far away from the 10-week as we would need to begin considering us in that good spot. Now we just need to keep it. So ranging up a little bit more, we're just holding the line. We don't want to see this fade back down and get below, say, 2 to just have a starting point, and certainly not below 1.5. We don't want to see this fade back down again. We've got examples where we've made this kind of move before and we just faded back down again. And we can see what we were getting at a price during all of that. A whole lot of nothing. This was a correction in time. The market went sideways, gave that 10-week time to catch up to the market. Well, I'd rather just skip that if we can. Bitcoin's basically flat this morning, but their proxies were on the squeeze list. Otherwise, there's nothing on the negative side to even focus on. VIX is up, but it had a contract change, right? It was an expiry, and we often see it as a gap when it swaps contracts. Retail's up, makes sense, with Target. China ADRs also up, staples, and that's it. The rest of these that are up aren't up enough. Nat gas is up a lot, but you don't want to rally from nat gas. We just discount that other than to recognize it's moving. I mean, retail came right back up into resistance, 77.5. And it's just 3 prints and we're just sitting there. So sure, it's up. It was red to green. We're completely outside of the previous day's range. And that's a bullish signal to have a red day that closed. And then in the pre-market, you rally all the way up and you break out of that red day's high and you open above it. Well, we're not open yet, so we still need to keep the breakout. but that is a good start to a bullish move. Getting that kind of a gap up, it's a bullish signal. The China ADRs here after that big move yesterday in KWeb, seeing it up even a little bit this morning. We're going to be focused on getting that half back. If we can get above 26.5, then sure, we could try to go for 17 or 27 and then possibly, get up into 27.5. What's more likely, or at least what I'm looking for, is a rejection at 26.5 and then falling back down, breaking the low of yesterday and continuing the move to the downside, seeing if these buyers are still here around that $25.50, $25 area. They picked it up last time thinking it was on sale. Will they do it again? Nice continuation in silver. We had a little bit of a pause yesterday, and now we're back at it again. This is still a beatdown market. We came back to the year-to-date VWAP, but there's nothing here other than just some intraday juice. Ag is up, but right at resistance. That's a very wide, ugly inverse head and shoulders too. On structure, if we were looking for it to use for an example, that would be a good one. The only thing that I would point out is when you get an inverse head and shoulders, to me, it's much better to find one at the lowest end of a long run, right? So at the highs with a regular head and shoulders or at the lows with an inverse head and shoulders. This inverse head and shoulders is basically on the halfback. At least it's on support. We can give it that, but it is a head and shoulders inverse. It's ugly, kind of squished, all janky, not very clean, but it is there and it is on structure. So we'll see if we can get a run on it. If we can get above that 24.60 area, 24.5, that buy zone, then we could try to get through, say, 25.5. All these sellers up here. See if there's any sellers left. Pot stocks, they really just haven't been interesting. It shows they're up, but there's nothing to it. And the flows haven't been that great. Well, that wasn't bad yesterday, but it seemed like a lot of time we're focused on pot stocks, and it's just that initial burst. You get a big move in the first 5-minute candle or maybe the first 10 minutes, and then that's it, right? And it's just sideways after that. Or it makes the move in the pre-market, and then it just doesn't do anything through the rest of the day. And they're not good tradable opportunities, right? Even for day trades, because the whole thing is done before it even gets started. So yesterday offered a nice run. We'll see if we can get anything out of it off of that, but still just a day trade. And if we can get started, it's a big if. If we can get started, there could be a swing back up to the year-to-date VWAP, but I don't see it at this point. There are the election trades, depending on which side is winning in the polls. We do see a little bit of movement in those particular basket of stocks. So on that edge, we could see something out of pot stocks that take us back up to 8.5. I wouldn't expect it. So if we can break out and start moving, then sure, why not? And then staples with a nice little continuation here. This is really starting to look like a blow off top. Today, a gap up exhaustion play, right? There's different kind of gaps. And when you've already had a really big run and then you gap at the top of that really big run, really kind of implies a blow off top or an exhaustion gap. this isn't like a gap and go. At least it's certainly not looking like one. So if we consider it from that point of view, and this is going to end up being, say, the high of the week at least, then a call credit spread into Friday wouldn't be a bad idea above 82, or even right at the money if you can catch it. If it works out really well and we fall really fast, it'll go into profit quickly. And rather than just closing it out, it's working. So then you can kick the can down the road, roll into the move, get even more credit, try to milk this thing. I don't think we're going to crash and burn necessarily in staples. We're just looking for some weakness back down into the range. So I wouldn't roll it lower than 80. Crude oil inventories, 20-year bond, FOMC minutes, and I mean, Jackson Hole's going on, but it's not POW until Friday. So, just keep your eye on the news as it's coming out through the day. Look for anything that's going to shock the market. Otherwise, we wait. Everybody be careful. Be